Everyone. Hope you're all keeping well and staying healthy. Welcome to the finance webinar arranged by the HBS Club of Singapore as part of the mentorship program. A special thanks to Adeline, our panelists, of course, as well as the others in the mentorship steering committee for making the session possible. This afternoon, we are very fortunate to have a diverse panel from Mehak, Deep, Elizabeth, and myself as we cover different industries within the finance sector, ranging from investment banking, asset management, private equity, hedge funds, retail banking, payments, and wealth management. So a lot of ground to cover. I shall be doubling up as moderator for the session, wherein we'll be spending about 45 to 50 minutes talking to our panelists about their career path, an industry overview, how they view the industry changing, and what to expect as a fresh graduate entering the field, as well as some general advice. We will have about 10 to 15 minutes of Q&A with the audience, so I encourage you, if you haven't done already, do come up with some questions, some of the burning questions that you have that you'd like to ask our panelists. After all, this is your forum to learn more about the finance industry, so no question is a silly question. As a matter of housekeeping, please keep your devices on mute unless you're speaking or asking a question to avoid any disruption. So without further ado, let's dive into our conversation with the panelists. So I think we probably can introduce ourselves. Maybe we can start off with the academic background as well as your career path, maybe a couple of minutes on it, what attracted you to the industry, and how you've navigated it thus far. So maybe we can start off with Mehak, if you're okay.
Sure. Well, thank you everyone for joining. Great to see so many people interested in finance, so many girls especially. It's great. So my name is Mehak, as Shabham mentioned. I studied economics all the way until business school. I did a first degree at the Delhi University in India, and then I went on to Oxford, where I studied, where I repeated my BA. And I studied what they call the PPE, so politics, philosophy, and economics. I got the Rhodes Scholarship. So I used to be in another life a sports person, and I used to do a lot of basketball and netball. And so that's been one of the key things that I've done through my life, and that's helped in work settings as well. But we'll likely get to that another time. And then at HBS, my background is obviously general management. So that's my academic grounding. It's liberal arts in economics. And then I overlaid at Oxford, I dropped the philosophy because I found it too abstract, and I overlaid politics on it. So I did international relations, and that's what I wrote on. And even now at GMO, I continue to kind of follow international relations and write for it at the firm. So my first couple of jobs outside when I graduated were in the finance space, various internships at various different banks. And I liked that. And therefore, when I finished Oxford, I joined HSBC in London, doing investment banking. I did that all the way until I went to Harvard Business School. And then I did the same thing at Goldman, but I changed my sector. So at HSBC, I covered transport and logistics. And then at Goldman, I covered what is called the TMT sector, so technology, media, and telecom. So I went in there on Wall Street. This is the team that took Facebook public. It's the team that, it's done all the mega deals, Time Warner, etc., thinking I'm going to get placed on all these glitzy deals. Instead, I became the semiconductor analyst, which is far from my technical expertise, but you eventually realize a company is a company, you're just modeling cash flows, etc. And of course, it's nice to be on some of the more glitzy names. But anyway, I became the semis and the renewables, which was covered out of TMT, kind of analyst and then associate on that team. A couple of years in, I realized that I could stay in banking, and then that would come at the cost of life in starting a family, etc. And I decided to find an adjacent industry that still uses some of my skill sets, but I can get closer to the client and the end customer. And hence I moved into asset management at a firm called PIMCO, which is the largest bond fund manager. And over that, when I was interviewing for that role, again, I was getting pushed to be what they call a portfolio manager. So somebody who selects bonds that goes into a portfolio, and then a pension fund might buy this bond portfolio, or an endowment might buy it. But by then I kind of learned from my mistakes, saying, I really love it, but I'm solving to get a little more work-life balance. And so I went for this other role called a client portfolio manager, wherein I explain to clients what's in their portfolios, but I'm not making the active investment decision myself. It's still intellectually stimulating because I'm on top of the markets, etc. But it is not as burdensome as being the PM is. And so that was a conscious choice I made. Many thought, it was, the one was trained for the PM track, and that's the track that I'd gone on. But anyway, that's what I did in New York for 5 years. And then I decided, my family and I were both sets of grandparents for our kids are in New Delhi, that we want them to be close to them. And we moved to Singapore as a nice middle ground. And at Singapore, I've been at a firm called GMO, which is Grantham Mayo Van Otterloo. It's founded by an HBS alumni, Jeremy Grantham, often in the same pedigree as Warren Buffett, who some of you may have heard of. And so in Asia, I now look after GMO's business in Southeast Asia, so Hong Kong, Singapore, Thailand, Philippines. I'm in charge of all our clients and then growing the business. Shabnam, way too long, I apologize, but that's me in a nutshell.
Not at all. Very fascinating journey that you've taken, and I'm glad that you also added the work-life balance element, which keeps cropping up. So I'm glad you kind of rationalized your decision making as you went through your career. Maybe we can get Deep to also chime in on his career so far.
Sure. So I think the commonality there is that I was also born in India but moved to Australia when I was a young boy. So I say I'm Indian born but Australian raised, and decided to make a conscious decision to move to Asia 10 years ago. My career's been quite diverse, and that's been deliberate. I like experimenting. I like trying new things. So I did a bachelor's in international business with RMIT University and ended up working at Coca-Cola for 3.5 years. And then in the heyday of banking in 2006, 2007, where all of my friends who copied my university schoolwork were making multiple more dollars than I was, I decided I'd transition across the banking and finance. So in January 2008, a very good year to become a banking professional, I moved across to ANZ. During my time there, I worked predominantly on the corporate lending side, doing product and lending. And very quickly, I realized that everything to do with banking was a financial instrument, which in effect was a legal contract. So I retrained. I went to Monash University and did a Juris Doctor law degree, very deliberately, because I was wanting to compete in the international arena, and there was hunger and ambition to do more than just commercial lending in Australia. So I needed to, in some way, add brand to my CV. So ANZ is very well known and regarded in Australia, but my university degree was not so much the case. So Monash University is a top tier law school in Oz, where I spent the following 3 years doing my law degree whilst I was still working. A very tough situation, and I would not recommend working and studying at the same time. It's very painful. And then subsequently decided that the time to leave Australia was right in 2011, when I moved out to Singapore. For me, it was a simple trade. It was short Aussie, long Asia. I felt that the economic output in this region, as well as the opportunity set, was far more tremendous, and it's proven correct. I ended up spending 5 years at Bank of America Merrill Lynch, again on the commercial corporate lending side, doing structured products, and then subsequently moved to a credit hedge fund where I spent the last 3.5 years. Formally finished with them in August, and now just doing some consulting work, enjoying my family, and getting fit again after a very long time.
And Elizabeth, would you like to add in your intro?
Sure. Hi, I'm Liz. You can call me Liz. So I'm Singaporean, and my background and my professional experience is much less illustrious than the first two. So I'm Singaporean. I went to local school. I went to MGS primary and secondary and ACJC. for my JC. So shout out to anyone who went there too. I decided to go overseas to get my undergrad degree because I'm sure we all know that, Singapore is quite a small place. So wanted to explore the world a little bit. I ended up going to USC to get a bachelor's degree. So I did a double degree in business. I did a concentration in finance, but I also did another major in accounting. I would recommend for anyone who's interested in finance, I think whichever route you go to, accounting was to me one of the most useful subjects that I learned in undergrad. So I would highly recommend that. After getting my undergrad, my parents wanted me to come home to Singapore, but I still really wanted to stay abroad. So I ended up, even though it was quite difficult at that point in time because it was after the crisis, I got an IB offer from one of the bulge bracket banks, and I was actually very lucky to get into this financial sponsors group, which is basically the group that your clients are private equity. And so you help them raise funds for their deals. Through that, I got to know private equity. And, at first, I just thought it was the right next step. Everyone said, it's kind of what you do after IB, especially going to sponsors group. Your mentors also push you into it. But really, as I learned more, I felt like the people I got to know there, the mentors, the people who work it there, I really respected from a standpoint of, they're both intellectually very capable, but also very hardworking. It was also an industry and an environment where they teach you a lot, but it's kind of it's how much you put into it, it's how much you get out of it as well. So I thought from a professional development standpoint, it was highly rewarding. I actually stayed at my firm after IB for about close to 6 years and decided to get my MBA. So I got my MBA at HBS, graduated in May this year, and actually rejoined the firm, but joined in the Singapore office. So sorry. Sorry about that. So I joined the Singapore office, same firm. So I'm back in private equity now. Why I decided to do that after my MBA was, I did explore other career tracks. I explored VC, I explored startups, but I still love the intellectual rigor of private equity. Here, when you invest, you have a lot of data, and that I know personally is something that I really enjoy. Having to be able to make investment decisions based on data. So we can get into that more later. Something that I think really attracted me at the end, and just taking a step back and a recommendation to you guys is that it is a profession where you can feel like you're your own boss. It's not and no discredit to any other profession, but something like consulting or law, you actually it's more of giving advice. Here, you get the advice, then you can act upon it. So that's something that really attracted me to it, and why I'm still here.
Great, thank you, Liz, for that overview. So for myself, again, my name is Shabham. Kind of a different background from the rest of our panelists. I've been predominantly in the financial services sector, but with a marketing lens. So I started off with my undergrad at Swarthmore. It's a liberal arts school, graduated with an economics degree. During that time, I did intern with Credit Suisse, HSBC, as well as an audit firm. And I looked at different geographies. So with HSBC, it was India. With Credit Suisse, it was Singapore. And with an audit firm, it was the Philippines. So tried to get a holistic perspective of geographies as well. Then, as luck would have it, it was the dot-com bubble. I ended up in an ed tech firm, incidentally, as part of one of the SWAT alums connections, and was one of the 5th members there doing business development and content development. Did that for a couple of years, but then felt that my passion was actually marketing. So joined a brand consulting firm called Enterprise IG, which is part of the WPP group. Did that for a couple of years, and then decided to pursue my MBA with HBS because I did want to switch tracks more into the financial services sector. So as Mehak had mentioned, the MBA at HBS is more of a generalist degree, though I did take some electives more on the marketing entrepreneurship side. Then after that, basically ended up in Singapore with American Express, looking at their Platinum and Centurion cards, so more of the premium products in terms of customer insights, product development, value proposition. And then after a couple of years, had my first foray into private banking. So at the time I was at a women's conference, and one lady from ABN AMRO, the product head, she actually was intrigued by the initiatives in American Express. We got to talking, and that's how I made the switch from payments to private banking. My experience has been predominantly in private banking. So I've worked with the likes of ABN AMRO, HSBC, Standard Chartered, and most recently with JP Morgan, but all along within the lines of marketing strategy. So looking at, as mentioned, value proposition, go-to-market programs, etc. So now I'm at a point where, I want to actually pivot into tech. So I'm also, listening into the FinTech session this evening, which I'm sure will be quite interesting. So that's a bit of my background. Now, looking into the next question, a lot of, I guess, Mehak and Liz touched upon their industries in some level of detail, but maybe we can deep dive a bit more because some of the audience may be unfamiliar with the sectors that you've mentioned. So if you could briefly describe the industry that you've been in, as well as what are your views on how the industry is evolving over time, especially in the time of COVID and disruption.
Sure. So Liz is on mute, so I'll go, Liz, if that's okay. So I'll cover investment banking first, and then a little bit about asset management, since I'm maybe the only one doing it on this panel right now. So investment banking, as you know, is often a misnomer. I actually didn't know what it was other than the buzzword until I actually got the job. Like miraculously, I went through the interview also not really knowing what I was getting into. So that is quite normal. But I think obviously now with the benefit of having so much of information, it is good to know what you are getting into. So banks, as Shabham has also said, they're behemoths, right? So the same bank or the same financial institution has a business called investment banking. They have a business called sales and trading. They have various other businesses, private banking, for instance. So always look under the umbrella to see what else is there. Frankly, when I came out of undergrad in 2004, my second degree, when I looked at a Goldman, I only thought investment banking. I actually didn't know of anything else. And in retrospect, maybe I would have been better as a sales trader or something else. But anyway, so that's one point to make. So investment banking, which is the area that I was focused on, is essentially the act of companies buying or selling themselves or part of themselves, and then accessing the capital markets to raise money. So both debt and equity. So IPO, the Airbnb IPO that just happened is an example of a private company going to the equity markets and saying, give me money now so that I have a public currency and I'll give you shares in myself. So that's the type of stuff I used to do when I was at Goldman. So working on both IPOs, so the capital market side, as well as just the pure play M&A. And that can get that has different variations within itself. So that's investment banking in a nutshell, but really urge you guys to look at other parts of banking as well before deciding whether investment banking is for you. I'd say investment banking, Liz was getting to this in terms of characteristics, is a great training ground for anybody coming out of school. It teaches you persistence. It teaches you not to give up. It teaches you attention to detail. And there are really little substitutes for that, I think, in your entire working life. You're not going to be doing M&A deals, but that attention to detail, looking at something and seeing there's a typo, looking at some numbers and saying this doesn't add, there's a problem. That's a great skill set that is really valuable. The flip side, of course, is that you're a workhorse. You're a workhorse for a couple of years or however long you decide to do it. And people do it their entire career, but really know that you're committing to something in the long term because the rewards in the gestation really take some time to get there. the analyst and associate years, even the VP years are pretty gruesome and grueling. So think about kind of, what works for you, your personality, what's your vision. But whatever you might do, I think you'd hear from all the mentors, there is little substitute for hard work, and getting that done early on in your career, those 5, 7, 8 years, sets you up really nicely and gives you flexibility later on, especially as a woman. This might come up, just getting that under your belt, getting some brands under your belt gives you flexibility, because people question you less when you want to make changes, when you want to try something else. Shabham, give me a sign if I'm saying too much. So that's investment banking. Asset management, really quickly, is the act of managing money for people who have the money. So you're managing assets. So my firm is largely institutional in nature. So we manage money for, in Singapore, the institutions. Think of the MAS, think of the GICs, think of the Bank of Thailand, think of institutions like that, think of universities that you all go to, think of family offices that are really established. We manage money for them. And by virtue of that, I mean, we have certain funds, both on the equity and the debt side, that they might like and want to give us certain money to get exposure to those equity and debt funds. And that's essentially what asset management is. We try to beat the benchmarks, and we try to beat the simple ETFs, so passive investment tools. And we obviously charge a fee that is more than what it would be if you bought an ETF. And even within asset management, as I alluded to, there are a range of roles. And you can be either on the investing side, or you can be supporting the asset gathering side, or you can be somewhere in the middle. I found it to be a better work-life balance. I found it to be still intellectually stimulating. And I found it to be closer to the markets. So I thought banking is quite close to the market, but actually there could be days that I didn't need to read the newspaper in my job, and I can't go a couple of hours if I didn't do it in my current job. So those are the aspects I liked.
Thanks, Mehak. So I think, we'll get into the organizational structure as well as the team roles in our respective sectors. But maybe if you could also touch on the evolution of the industry as you see it, especially in times of COVID and innovation disruption, just briefly. Mehak, do you want to just continue, and then we'll go on to the other panelists as well?
Sure. So Shabham, that's a great question. And it's a question that I personally didn't consider at all. And this is a great thing you guys should think about. You always want to be in a growth sector. And Shabham alluded to looking at tech. I might be looking at tech myself just to know. And I'll talk about banking. So banking is going nowhere. Investment banking is going nowhere. Companies will always want to buy and sell. Companies always need to access the capital markets. So these banks have had an enormous, they've done really, really well this quarter. Deals have happened on Zoom. When I talk to some of my peers who are now MDs at Goldman, at JP Morgan, etc., banks are going nowhere. They've found ways to pivot and make their business more profitable, actually, in this period of time. A lot of companies will go under, unfortunately, with COVID. And that means there's opportunity for others. And so banking is still a very healthy and robust sector full of opportunities going forward. I wish I could say the same about asset management. I think asset management will have to morph because the idea, as I alluded to, is in asset management, you are charging people more than what they would if they bought ETFs on Phillips Capital, for instance, or Interactive Brokers. You're charging maybe 1% more from your returns. People want you to be delivering more than the benchmark. And the simple truth is that active management has not been able to do that. most managers have trailed passive indices, other than a couple of hedge funds that hit it out of the park, etc. But that's a different story. You know, there are questions of sustainability, there are questions of leverage, etc. in those hedge funds. And Deep will take me on in this and say that's not true, and I welcome you to do that. But in general, the asset management industry is one which is likely to see consolidation. My firm is quite small now. We used to be 100 billion. We have suffered. We are today 50 billion, so half. And it's likely to be a place where certain big firms swallow up certain smaller firms. And if you decide to remain small and private, you really need to know your niche and what you're selling. So definitely think about the evolution of the sector you're going into.
Thanks, Mehak. Before we get into Deep, I know we need to give him some airtime as well. I'm just going to briefly touch upon private banking because it's related to asset management. So as Mehak mentioned, that asset management actually distributes products to institutions, whereas private banking is actually a sister arm. So they actually distribute the asset management products to high net worth individuals or ultra high net worth. So certain firms define it differently. High net worth is usually 1 million and above in terms of assets under management, whereas ultra high net worth individuals can range from a minimum of 10 to 30 million in assets under management. But in terms of how the industry is evolving, I agree with Mehak. You know, these behemoths are there to stay, especially like the likes of even DBS and JP Morgan. They're also making strides in the digital landscape. So they're there to stay, but I would add that on the extremes, so Mehak had talked about family offices. I think they're gaining importance in this region in serving, you know, the very ultra high net worth creme de la creme clients have their own, if you will, wealth management outfit to manage their own money. And on the lower end, if you go downstream in the affluent space, you are now having robo-advisory firms like Stashaway and Wealthfront in the US. A lot of these firms are kind of eating into the pie in terms of managing wealth in an automated way using algorithms and AI. So I think that's eating up into the space of wealth management. But I think a lot of the bulge bracket firms have recognized that and are working with the fintechs alongside them. But you will see some consolidation in the medium portion of the industry. In fact, UBS and Credit Suisse were also talking about merging during this time a few months ago. So you will see that sort of consolidation going forward. Now I'll move on to Deep because he's been patiently waiting.
Admittingly, I think Mehak has taken my thunder because she mentioned everything I was going to speak to. But so let me answer the question slightly differently, which is I think at a starting level, when you're looking for work, you need to be able to say, what are the things I like or I don't like? I'm an introvert or I'm an extrovert. I like working as a team or I like being an individual contributor. I like people interaction or I prefer to have a task where I'm left alone to deliver results. And a lot of that can define in which area you can feel comfortable in when you go into a bank because they are large organizations. Or even if you consider wealth management platforms, whether it's GMO or PIMCO, they are huge. So your ability to transcend different business units is also an option. And when you go into those positions as a graduate, generally speaking, there's some form of rotation program to allow you to spend 3 months at a time in different business areas before you yourself get to decide, actually, that's the area that I want to participate in. So in some ways, my point is understand yourself, know what you enjoy doing and some of the challenges you do face, and then just go ahead and experiment with those rotation programs because in some ways that's a bit of a try before you buy, that you'll be able to see what you like and what you don't like and then decide for yourselves. Now, I went through that process with ANZ and I must admit I spent 18 months in investment banking and that was really sitting at a seat, pumping out Excel models and doing pitch decks. And for me, I could have just been a graphic designer and done effectively the same role, or been a financial modeler and done the same role. So that client interaction that I was really hoping for wasn't there. And it was usually me being dragged along as, let's call it the finance analyst, rather than to be able to have a strategic conversation about a deal structure. That was despite being a lawyer and despite having a track record of delivered financings to very large corporates. So for me, the decision was actually, that's not for me. So I moved countries and I moved roles. And I think just keep an open mind in that if you're doing a role and you're not comfortable with it, change and change early. Because the last thing you want to do is find yourself in a situation where a lot of my friends who are anywhere between 32 and 38, they've missed the opportunity to either build a career that they're satisfied with or a personal life that they're happy with. And that goes back to the earlier point being raised, which is how has the industry changed? Before, it was very much driven by money and driven by financial outcomes. And admittingly, that's what attracted me. I was on a particular salary and my friends were making 3 times more. And I thought, well, actually, I know I can do that role. So I did it. Now, was that the right driver? Absolutely not. But I also had an underlying passion for financial markets and finance generally. So I think just also understand what your driver is, because I think a lot of people are still stuck in the pre-financial crisis concept that there's outsized returns to be made, even in investment banking or in corporate banking. And I can say that despite having a varied career across 2 or 3 different companies across industries, I've actually out-earned a lot of my friends because I've been willing to bring different ideas and different concepts that have allowed either the bank or the credit hedge fund to do business in a different way that allowed it to grow its value proposition. So I think there's more to it than just being able to identify the type of role you want to do. I've had the other extreme where I've had friends doing the same job, the same role for 15 years, some at UBS who started analyst, associate, VP, director, managing director, co-head, CEO. They've worked through that ranks and they're absolutely satisfied. Point being that if it's a passion and something you enjoy, you'll get a lot out of it. But if it's not, there's the opportunity to change because that's available to you. Now, in terms of the piece around hedge funds and ETFs and whatnot, I think they exist because they serve a value proposition. There's always going to be a gap in the market that can be filled and a transaction that can be done within a particular platform that can't be done elsewhere. And, you know, there's this concept of regulatory arbitrage that exists between private credit lenders and banks. There's arbitrage that exists between ETFs and listed investment corporations, between active management and passive. So there's a lot of opportunity to define what your own product is when you're working within those organizations. And if you think that, hey, I think I can do this in a different or unique way, there's probably a value proposition that you could explore for yourself, which is, doesn't make sense for me to launch an algo fund because I've got a computer science engineering degree. I've spent the last 3 years in investment banking, and I now know how to optimize these models to deliver a financial outcome to investors. So I think keep an open mind about entrepreneurship as you're working through some of these large organizations.
Thanks, Steve. Let's move over to Liz now.
Sure. Yeah, so I think they pretty much covered quite the gamut of investing. So maybe just going, touching from asset management. So private equity is really an alternative asset class that asset managers might allocate money to. So these investments are traditionally seen as, higher risk, therefore should, get a higher return if it works out, and should beat the stock market, which is kind of the benchmark returns. Private equity, it's traditionally you're investing in an investment that is non-public, it's not traded in the public markets. So for example, if you compare it to Google, you can buy and sell a Google share within seconds and get your money back. But for private equity, typically, the investment horizon is longer term. So you would expect your money to be returned to you within 5 to 7 years, but typically not before that. Also, the main sources of these private equity funds are large institutions. So, for example, like what Mehak said, think about GIC, Temasek, you have pension funds, but we also raise capital from high net worth individuals. So it's not also an asset class that's easy to get into unless you have large pools of money. And this is also because the investments are typically for control. So you would look at a public listed company, maybe $1 billion, and you're actually trying to get control of the company. So you would want to, maybe own more than 50% so that you have operational control so that you can drive change. Because you need more capital. That's why these private equity funds are much larger. The typical ways or strategies are, one that you would read about a lot is leverage buyouts, LBOs. So that's the firm that I work for. This is the strategy that we use, and in a simple way, it's kind of like taking out, buying. So I'll just put it. So basically, you take on debt and equity. You take on debt to acquire a company, and essentially, the more debt that you take on, the higher your returns can be. But as long as your company that you're acquiring is able to service and pay down the debt. So this is similar to taking a mortgage loan to buy a house, and then renting that house and using the rental income to pay down the debt that you owe to the bank. So for example, if you buy a house for $10, and I'm going to try to say this slow, so maybe it gets across, but you buy a house for $10 and you take out a $5 loan and pretend that it's no interest. And then you rent out the house for $1 a year. So after 5 years, you would be able to pay down, the $5 that you owe to the bank. And then after that 5 years, you sell the house for $10, the same price that you bought it, but you get the full $10, right? Because you've already paid the bank back. So you put in $5 and you get back $10. So you've made 2 times your money over 5 years. So that's essentially what private equity firms do with an LBO. That's a very simplistic example, but that's fundamentally, the math. And so we try to buy companies that are able to pay, that generate enough cash to pay down, the debt that we owe to the banks, who give us the debt capital needed to fund the transaction. So essentially, that's the easy way to put it. But it's a high risk in that when you buy a company, you don't know whether they would truly make that much money each year. There could be macro risk. Like for example, you buy, like if you owned a travel company a year ago, probably right now it's in distress. So if you had put debt on that, it probably would have defaulted in the debt of what they owed the bank. So therefore, there's high risk. But if you do assess the company characteristics right, you put in structures in place that can mitigate the company risk related to maybe as an industry. That way, the way you structure it, you can protect your downside and ensure that your risk-adjusted returns are high enough. So that's private equity, and for me, I do think that it's still a worthwhile profession to pursue. Maybe let me talk a little bit more about the pros and cons. So the con is, yes, you do have, it is very, very demanding. Speaking as a woman, you do have to, I think, when you reach a certain stage, think about work-life balance. And there are some firms, so I think my biggest recommendation is to make sure that you find a firm that supports work-life balance. And there are firms that do. So even though it's demanding, I think the trend is that there is more support for women entering the industry, more support for true work-life balance, even from a female perspective. That's what I see as kind of like the HR trend in PE. But just from a intellectual, rewarding standpoint and career reward, I do think that it's very lucrative. Yes, you make decent, good money relative to other professions, but I also think that the reward you get from it's entrepreneurial for me. And so when you're really able to create your own deal. In a sense, you go out, you assess the company, you own the company, you devise strategies and work with management to affect change in the company. So I do see it as fulfilling from an empowerment, but also seeing, the impact that you can have on a company. So all that, I think, makes it a rewarding career.
Thanks, Liz. In interest of time, I'm going to combine a few questions. So sorry about the long-winded questions, but maybe we can start off with Liz, actually. I think she has gone through the ranks, starting off with the finance industry, just looking at the LinkedIn profiles. So maybe if you can talk about the type of roles and structure within your organization, a brief day in the life of the first-year employee, as well as career progression, both internally and externally. So what are the resources or opportunities available to be mobile within the firm, but also, you know, as an exit strategy, how do people actually migrate from private equity, let's say, to another sector?
Sure. So for disclosure, I've been in investment banking and then private equity, and I've only been in one private equity firm. So really, these are just, you know, based on personal experience. And what I do know is that each private equity firm is actually quite unique. What is different between a private equity firm and an investment bank is really the size. You can find maybe like 24 investment professionals at a PE firm, and at a bank you have thousands of employees. So first, looking at investment banking, in the investment banking, you know, the entry points are really as a fresh grad. So I would recommend that, you know, if you're interested in investment banking, go to study valuation, study financial modeling, study probably pursuing a business degree. And I didn't go to undergrad in Singapore, so I'm not very sure how the classes are structured here. But in the US, it would be, you know, you can actually enter with any degree in the US, but you do need to be able to, you know, pass the interview. And the interview consists of a lot of financial questions. There are databases online that can help you prep. I think there are also tutors online that can help you prep. But the interview process itself is quite rigorous, and it also includes, you know, like a paper modeling test. So, you know, you do need to be comfortable with math and be comfortable with having, you know, 50% of the day you're doing some sort of math problem or Excel modeling. So entry-wise, you would enter as an analyst, and in the US, you typically do 2 years of analyst before you enter maybe the buy side. And in the US, it's very structured, where there's a big recruitment, you know, exercise. So there are a lot of recruiters out there that specialize in recruiting investment banking analysts to go to private equity or hedge funds or VC. In Singapore, I know it's a little bit, or Asia in general, is a little bit more ad hoc, and actually a lot more investment bankers stay in investment banking. And so a lot of my friends who entered investment banking, they're still there, and they only leave, you know, after 5 to 7 years. And so after analyst, you have associate. You know, if you do well, you can be a VP, go on and on in investment banking. If you do enter PE, the entry points are usually after 2 to 3 years of investment banking. If not, you kind of have to take a pay cut or title cut to join a PE firm, because they're very few slots each year, and some of the smaller firms only hire, you know, as needed. So it could be 2-3 years. During COVID now, it probably pushes back some of the recruiting cycles. But you have to be opportunistic of when you enter PE, and you probably don't have that much of a choice of, you know, leverage when you're trying to negotiate your package, your title, all that, because there are a lot of people trying to get into private equity also. And in PE, you start off as an associate. Some firms, they have different title kind of progressions. You could have, from an associate, you can go to a VP, or, you know, associate, senior associate, and so on. I would say the role as an analyst in investment banking is really what Deep said. It's very much sit at your desk, pump out model after model, pitch book after pitch book. It's only typical as an associate above, you get taken to client meetings, but that's also quite rare. I would say in private equity, it's very different. You know, as an associate, you really, because you are the client, right? It's an industry where you are the client, and you're not making work for clients. So they come to you, and the associate, because you work in such small teams, you really have a lot of responsibility. So I would say that the thing you need to be comfortable most and understand about yourself, the qualities to be able to or to thrive in it is, one, you really need to be comfortable in being uncomfortable, being uncomfortable, because there'll be a lot of situations where you have not done this before. And because teams are so small, you don't have the one-on-one mentoring or teaching sessions like in investment banking. And so you have to just learn on the job and be okay with that, and be okay also with, kind of not having direction at times. So if you feel like you're someone that's pretty entrepreneurial, has your own like can-do attitude and just do it, and not afraid of failure, right? Because a lot of times when you don't know how to do something, you won't do it well the first time. But if you have that mentality, I think you can really succeed in it, because it is something that you learn on the job. I don't think anyone can tell you exactly what private equity is, because every deal is different. It's really understanding the markets, understanding where the deal opportunities are dependent on the cycle of each industry. And then, even working with management teams, each deal is so different. Well, yeah, that was very long-winded, but what I would say is that PE versus IB, PE is a lot more entrepreneurial. It's a lot more, also, I believe, a lot more empowerment in your role, a lot more roles and responsibilities, but it's more rewarding that way.
Thanks, Liz. So I'm just conscious of time. We want to leave about 10 minutes for Q&A. Maybe Deep and Mehak, if you could briefly touch upon the career progression angle as well.
Yeah, sure. I think just to echo Liz's point, right, that you need to be comfortable with uncertainty, because people are not always going to be around to give you direction or guidance, and to be able to one, be willing and able to make mistakes, and two, how to correct those to an adequate standard, so you're learning, developing, but also delivering positive results from there forward. That's key. I think the other advice is, don't make a career change in crises, right? At the peak of the financial crisis, or at the peak of the COVID crisis, you don't want to be trying to change career, because the demand side's not there. When the market is absolutely hot and there's hype, then you can start considering the transition, because in some ways, well, transition's hard. And then to have headwinds as a result of let's call it a macro overlay, whether it's a health crisis or a financial crisis, it gets even tougher. Now, it's not to say it can't be done, because obviously a lot of people here have done it across either investment banking funds within finance itself. So it's certainly possible. In terms of career progression, yeah, very, very similar, right? I think large organizations are very structured. So if you do like that structure and do like that guidance, I think following that well-worn path is very useful. If you say, hey, I want to be a trader, or I want to be in a portfolio manager role, or in private equity execution role, then the good news is that path is already well-worn and it's well-written. So just follow that track, and you can research that yourself, or connect with some of the mentors here to ask specifically what that means. But I think the key takeaway here is, follow the process for the organization you want to work for. So if you've identified, hey, it's Goldman's, or it's GMO, or it's Platinum Equity, they'll have their process that you need to follow. And then network to be able to create that own opportunity set for you. Because you can be in the job, but the job's only going to allow you progression and promotion based on KPIs and outcomes. But the hardest part is getting in, right? So I think focus on that for now, because of where you are, and then you can worry about the progression piece, because you will learn and develop as you go.
Mehak, would you like to add on?
Shabnam, I have little to add. I think they've said all of it. The only one point I'll make is that we often hear as millennials, people try a job for 2 or 3 years and then move on. And Deep also made that point. It's good to cut your losses. But what I wanted to say, look at the flip side as well. Sometimes it takes time to get your teeth into a job and understand it, improve yourself, and come over that learning hump. And there is value in persisting if there are certain aspects that you do like about it. you make yourself more valuable to a potential next employer as well if you have stayed for a while and there's certain skills that you've picked up. So, you know, many of us constantly see applications of folks that have done 2 years somewhere, 2 years somewhere, 2 years somewhere, and they're perhaps not the first people we want to take a bet on. And so do yourself the honor and respect to do the diligence up front. But if you do commit to something, and yes, of course, there's progression, etc. And Liz and Deep have kind of highlighted there could be formal progression. In smaller shops, there's more informal progression. You can do different roles, but try to stick with it. Like, give yourself a little more than 2 years, 3, 4, to really know, because, you know, your working life is going to be, you're going to have time, right? So really know, why is it that you picked what you picked? And if you're opting out, know your reasons fully for opting out. And there is gains in a process of elimination as well. But really don't give up and then try job hunting 14 months into your first job. That's kind of a waste mentally, emotionally, in a lot of different ways.
Thank you. Yeah, that's a really good point. I think it depends industry by industry. So if you go into the tech industry, they do appreciate you getting different perspectives and laterally progressing in your career. But by and large, in the corporate banking field, I think they do also value the stability in your resume. So you know, as Mehak mentioned, do persevere for a couple of years before moving on. Let's open the floor now in terms of audience questions. Would anyone like to go first? Okay, we have from Aishwarya a question: what skills or qualifications should we acquire to increase our chances to work in fintech? I think that could be addressed in the session in the evening, Aishwarya, if you'd like to attend that. But does anyone else on the panel have a perspective on that?
Yeah, I might just chime in there. I think a lot of the fintechs that are now coming to age generally hire more senior people because unfortunately they haven't got the ability to spend a lot of money on training development and giving you the 2 or 3 years that you need to get to that stage. So I think cut your teeth within other organizations, within products that you have a sufficient interest in. So if it's payments that interest you, then work for MasterCard. If it's lending that interests you, work for a bank. If it's doing or underwriting IPOs, work for an investment bank. But then just try to figure out which players in the fintech space you want to align yourself with, because all of them are trying to address a very different problem.
I can chime in as well. So yes, you can absolutely do that. And I think Deep is right. In the market in Singapore isn't as big as it is in other parts of the world. But institutions like the MAS have a lot of incentives to encourage grassroots innovation. And so to the extent, so you say skills and qualifications. So again, fin and tech, right? So that's kind of obvious, the type of qualifications you need. But you know, there are lots of other groups, and join the session in the evening. But there are lots of other groups that says, yes, if you have the academic grounding, at least in both finance and technology, or one of them, and can find a partner to complement your skills in the other, and you have an idea that is in any one of these places, insurance, tech, etc., crypto, whatever it might be, you could go down and kind of, you know, learn from one of the bigger institutions, or you can experiment yourself and start something yourself. And indeed, the MAS has lots and lots of incentives. And there's a Singapore FinTech Festival that is done really well. It's nascent. You have the benefit of joining in an evolving industry, and early movers always have an advantage. So no specifics here. This isn't the FinTech panel, but I think Singapore is a very good place in the world to be if you are looking at FinTech at this point in time.
And I'd just like to add as well, if you are in, let's say, a financial services firm, the challenge that I've had is the FinTech firms do look at your profile and sort of silo you. There are some stereotypes, unfortunately. So to break that barrier, if you're still with a financial services firm, internally try and get into projects. A lot of these firms have innovation labs, so you can try and experiment and gain exposure into the fintech side. A lot of them, like JP Morgan, have partnered with a lot of fintechs. So that's how you get experience and exposure to then translate your experience with a financial service provider to a fintech. And also in parallel, when you're working with a bank, let's say, you could also volunteer your time as an intern somewhere else, right? So it doesn't preclude you from doing that. And that's how you also get a more holistic experience. Any other questions? Okay, I've got one from Tasha. Thanks for sharing today. How important is good school clubs portfolio besides good grades and good internships to gain interview opportunities at big financial institutions? I think this is talking about the brand names in terms of the MBA further studies.
Yeah, I might take that one because I experienced it firsthand. So RMIT, it's a decent university in Australia, but it's not top tier. And I graduated top of my class. And every time I went into interviews, and I did close to 20 of them going into Coca-Cola, it was always a conversation about the university and not my grades. And then I actually did the Juris Doctor Law degree where I passed with an average or of a credit. And it was always a conversation about the brand. So it was telling that in some ways, people have, and I guess rightfully so, because the breed that enter those schools needs to be of a particular level. And then, of course, the training you get at those institutions is fantastic. And I think Harvard is no different, as is LSE or Oxford, for that matter, to build that, not just the character, but the academic that walks out of those institutions. So I think for me personally, I would actually give a lot more weight to that than the knowledge I obtained. Now, another way to consider that is that we sit in front of the world's largest library every day, right? Our computers, we jump on Google or Bing or Yahoo, whatever you use these days, and you can source information, source intelligence and knowledge. But the network you build, the branding you get, and that association, that's actually what brings a lot of power to your CV and your ability to at least curate a very successful conversation, because you've worked with people who are in that ecosystem alongside you.
And maybe to add, also just more from a entry kind of to enter as an analyst to a bulge bracket investment bank. If I could prioritize or in order of importance, I would say number one, a good internship. Number two, grades and then school clubs. Why? It's because grades and clubs kind of get you to the right schools. Right. And then it's only at the right schools that you're able to get the right internships, unless you really network your way. Most of these bulge bracket banks, because there's so many applicants, they have to do, the first filter would be schools. That's almost the easiest way, because if they filter by schools, their thinking is that it kind of makes sure that they get, the people with the better grades. So it's just that inherent way, that the more efficient way for these big bulge bracket banks to filter. So I would say that you should prioritize getting to the target schools that these bulge brackets look at, which, these schools would be the top tier schools. And therefore you would need good grades and a good portfolio to show, your proactiveness, your engagement in the community. But then I would really, really, really stress the importance of good internships. So if you want to get an analyst role in a bulge bracket bank, they're not going to consider you, even if you come from the best school and have never done an internship. Nowadays, and I think it's even more so for your generation, and I know it was like that for mine. It's, if you wanted to get into investment banking, you better have planned ahead. So your freshman year, your sophomore year, your junior year, do something in finance, and then make sure at least in your sophomore year you did investment banking internship, so that when you're a junior, that's when you get your full-time offer. And why that's also really, really much more important is that they fill the analyst class actually with half interns. So it's almost like shooting yourself in the foot if you're not trying to get in, and you're giving yourself half the chance if you don't do that. So really get the investment banking internship and convert that into a full-time offer.
So let me chime in, Shabnam, if I can. And I will caveat that a lot of our perspective here seems to be how the US market works. Certainly Liz's comments and maybe so the Singapore market may work very differently. And I think that you need to figure that out. But this is what Liz has said. And maybe what I've shared is typically how recruiting works en masse at a lot of these in London or in New York or etc. The one caveat I'll say is that not everybody lands their perfect bulge bracket job in the first instance. And that's okay because people move around later. I would choose the functional area. Of course, you want the brand. And if you're lucky enough in school matters, but there are other ways to compensate. You can read, you can network, you have to have conviction. You find certain people, you get them out for coffees, you really get after them, right? Not in a pesky kind of way, but in a way where you show your value. Because you know what you're compensating for, right? You're asking them to take a chance on you because maybe you didn't go to that school. You studied in Singapore, and that's okay. There are a lot of brilliant people in my firm who are heading the firm who went up the ranks, were educated right here. So don't let that be something that holds you back. Research as much as you can to figure out who are these people, who are these organizations, etc., and find a way to get to them. You don't always have to start at a bulge bracket. You can start at another institution. Stay in touch with the market, stay in touch with recruiters, stay in touch with your network because people hire at all levels. And remember, you're taking a very long-term view to your career. You're not compensating for 3 years or 5 years. You're talking 20, 30 years. So a couple of steps back to get you to the right institution, to the right role. I repeated my BA. I switched jobs. People said, you're crazy. You're not capitalizing on your experience. It doesn't matter. Long term, it's your personal equation and you're solving, for yourself. Don't always follow the herd because everybody's track will be different. That's it, Shabnam.
Adeline, do we have time for one more question? Maybe 5 minutes? Relevant.
We'll let people who need to drop off. But actually to that point, Mehak, that's a really good point. So mentors, if there's a way for people to contact you, either through LinkedIn or your email or WhatsApp, if you could drop that in the chat so that people can connect with you if they have other questions after this. But Shabnam, I think it's okay to keep going with 1 or 2 more questions and then we'll let people drop off if they need to. Thanks.
I'm glad to see so much participation from the audience with all the questions. So there was one from Novi, and I'll probably add on to this question. He or she talks about, for someone with a graduate degree, with a general business degree, is it recommended to get accreditations like ACCA or CFA to supplement to enter the finance industry? And also, through our mentorship sessions, we actually have some mentees who don't have the internship experience or have done a finance degree. How can they switch then into the finance industry? Deep, would you like?
It's a great question. I think what those qualifications show is your persistence and your interest and your passion. And so there's no downside in doing them. But in the same way, do not stop looking. I think if you're doing a CFA or you're doing some form of accreditation, continue down that path, but make sure in parallel, you're still networking, you're still speaking to the right people. Because ultimately, what are you trying to achieve? You're trying to achieve an entry into an organization that you want to work for. Now, whether you've got that qualification or not, that's not necessarily what's going to open the door for you. It could. There's obviously opportunities to get recognized for some of the qualifications you have to get in, but the networking piece and the connecting and understanding the industry is going to be key as well. On that note, I do have to take leave, so I do apologize. I'm going to drop off.
Thanks, Deep. Thanks for your time. Elizabeth, did you want to just add on?
Yep, sure. So I think, and if I'm not wrong, and this might be what it is like in the US, but I think if there are some roles in hedge funds that you do need a CFA, so I would recommend you research. And I think LinkedIn is a pretty good way to try to, find people that might be willing to speak to you. Don't be discouraged if people don't reply, but there are a lot of knowledgeable people out there I would just shoot them a text, maybe go to them and meet for coffee for 15 minutes to just find out what the job is, because I think that's the best way to really understand the different roles there are in finance, because there are just so many. I do know that some require some accreditation, so I would put in the work to research and find out.
Great. Yes, so I think most of us have included, yes, I think all of us have included our Gmail or LinkedIn. So do feel free to reach out to us. Unfortunately, I think that would conclude our session. I wanted to thank the panelists, Adeline as well, for their time in organizing. And we hope you found this webinar useful. Thank you again.
Thank you so much, Shabham, for hosting and facilitating so brilliantly. And to all the mentees, this is an overview of the finance industry. Obviously, there's a lot of nuances, a lot of subsectors, a lot of roles. So if you're interested in this, please do reach out to your mentors, have one-on-one discussions, and advice on how you can network more with people in the industry so you can learn more. So you're at a learning stage. You're not going to know everything today, but this is the starting point. So you have an idea of what the different sectors are and what different job opportunities are. Okay. And so thank you again, everyone, for taking the time to join us today. We will have a recording of this. So if you'd like to watch this again or to share this with your friends, please do. And join us tonight for the FinTech session at 7 o'clock. Okay. Thank you, everyone. Have a good day. Bye.
Bye.
Thank you.